While every life has value, not everyone's needs are the same. Life insurance is designed to provide replacement income, cover a debt, or provide another financial replacement in the event of your passing. In this video, we'll answer the following questions. Why do people buy life insurance? How much should I buy? What are the basic types? How long will it last? How do I get it? And when is the best age to buy life insurance? People buy life insurance for a variety of different reasons. Some buy it to provide for their family in the event of their untimely passing. Others buy it as part of their inheritance or philanthropic strategy, while others may have life insurance on their own life owned by a company or business that they play a key role in. For this video, let's focus on the most common reason the average individual would buy life insurance policy: to protect his or her family. Many financial experts and publications will recommend somewhere between 8 to 12 times your income, but this number will vary based on a variety of factors. Everyone who is considering purchasing life insurance should evaluate their own situation, including the number of children they have or plan to have, how many partners are working inside versus outside the home, their personal debt load, college funding plans, and other financial ambitions, just to name a few. If Mary is the sole breadwinner in her home and wants to make sure that she is providing the ability for her partner to remain at home with their young children in the event that something were to happen to her, then on average, she would need more coverage than Stefan, whose partner also works and whose children are already independent. Part of the assumption is that Mary and her partner are younger and will most likely have less of their mortgage paid off, less accrued lifetime savings, and more earnings potential ahead of them. Stefan and his partner, on the other hand, are further into their working careers, so we're assuming that they have paid down more debt and are on track with their savings for retirement. Broadly speaking, there are two main types of life insurance: term insurance and permanent or whole life insurance. Term insurance can be thought of like renting an apartment. Much like an apartment has leasing terms, term insurance has a time limit and will only pay the death benefit out if the insured passes away during the stated time frame. Some term insurance may allow for renewal at a higher premium or allow a certain amount of time to convert from a term policy to a permanent policy. Common types of term insurance are level premium 10, 20, or 30-year policies, and increasing premium policies that can last up to, and in some cases beyond, age 80. Permanent insurance can be thought of like owning a home. Just as owning a home usually costs more than renting on the front end, permanent insurance will cost more than the same amount of death benefit in a term policy. Many types of permanent insurance also build an accumulated or cash value over time. This value can be used as collateral to be loaned against, or the policy can be cashed out for the surrender value, unlike term, which usually has no surrender value. Another piece of important information about permanent insurance is that it does not expire. Unlike term insurance, you are not at risk of outliving this policy, as they are designed to go to age 120 based on current mortality tables. Permanent life insurance can give additional options in retirement, including inheritance, leveraged use of the cash value, paying for your long-term care insurance premiums tax-free from your cash value under current tax laws, or even income replacement. Now, income replacement may sound a little odd in retirement, but remember that you cannot collect both your and your spouse's Social Security benefit once one of you passes away in retirement, so you may still experience a kind of income loss even in your retirement years. Aside from getting life insurance through your employer or buying a guaranteed issue policy, which are both limited in the amount you can purchase without medical and financial underwriting, you are required to follow the requirements set out by the life insurance company. While the specific requirements will be impacted by your age and the amount you are applying for, the insurance company will usually require financial underwriting, medical underwriting, and possibly a limited medical exam when determining your rate. Since your rate is, in part, directly related to your age and your health when you apply for life insurance, it's a good idea to plan ahead and start thinking about the amount of coverage you will need in the future, not just the amount you need today. For example, if Jill and Jim plan to have several children, it's a good idea for them to consider this when researching their life insurance options. It's not uncommon for people to have both term and permanent life insurance policies, or to start with one kind and later change to another. When researching life insurance options, it's important to consider the amount of coverage you will need, the length of time you will need the coverage, the strength of the insurance company, and the flexibility you have to make changes or convert the policy down the road. If you enjoyed this video and want to learn more from the definitive channel for financial education, don't forget to subscribe, comment, and like. We'd love to hear your ideas on topics you'd like to see covered. Thanks for watching.